Welcome, everyone, and welcome to another podcast. My name is Seewing Yee from the Yee Real Estate Network, and my co-host is none other than Mr. Richard Advani, an investment loan agent from Guarantee Rate Mortgage. How are you, Richard?
Doing great. Rates moving down a little off the highs, so that's refreshing to say the least.
Absolutely. Yep. Every kind of good news is good. So we have a very interesting topic. I just took the liberty of naming the title of this video is Open Door Policy. That's right. What does that mean? You're going to find out if you. So let me share my PowerPoint. What I mean by open door policy. Here we go. As a real estate investor, need to create your quote unquote open door policy. Here we go. Here's the big picture. This could be your blueprint, right? You buy one rental at a time consistently to a point where gather up as much down payment as you have available to get the financing to buy all of these houses consistently over time so you can scale and create a portfolio so you can achieve retirement, hopefully in the next 10 to 15 years. All right, so then the best way to leverage and scale your real estate portfolio, the road to financial freedom, go through debt, D-E-B-T, debt. That's right, good debt, not what Dave Ramsey says. Oh, get out of debt. Anyway, hate to pick on Dave Ramsey, but he is wrong in terms of mortgage debt. Whatever. Anyway, so what I mean by get more doors, each door you create, each rental property, if a single family home is one door, duplex is two door, triplex is three door, and fourplex or a quad is four doors. So the more doors you open up for your renters, you can achieve, the more wealth you're going to create for yourself and your family for generations to come. So let's dive deep into what I mean by doors. Okay, now not everybody can do it. I have done it over the years. For those of you who are starting out, if you're young enough, you have enough flexibility, you can do a house hack, right? House hack means you can 0% down VA loan. I'm an ex-military veteran. I have done house hacking. I've been buying several properties with 0% down VAs over many years. And so if you are lucky enough to be a military veteran, you can use 0% down payment to buy 2 to 4 units and live in one unit and rent out the others so the other renters can pay off most, if not all, of your mortgages. Furthermore, you can do FHA 3.5% down payment. Similar situation, 3.5% down payment. You have the potentially to buy 2 to 4 units. Same thing, house hacking. All you have to do is live at your house minimum of 1 year. And if you want to move after that time, you can get all your doors rented out so you can achieve cash flow, appreciation potential over time, tax benefits, let the renters pay off your loans, so on and so forth. And then, of course, the third tier of a house hack as a starting point is 5% down. Primary homeowners is a recent guideline by Fannie Mae. We did the video, Richard and I recently, 5% down, no PMI, primary homeowners. You could buy 2 to 4 units, once again, with 5% down, as long as you occupy a house. Primary home and owner-occupied property, you live in one of the unit and have your other renters pay down your loan. By the way, there's a lot of misconception. Getting a VA loan, 0% down for 2 to 4 units, FHA, 3.5% down payment, 2 to 4 units, 5% down, conventional financing, 2 to 4 units. You do not need to be a first-time home buyer. You can own tons of rental properties and you can still qualify to use this trifecta of house hacking methodology. So let's go on. Then once you create a portfolio of homes, here are the trifecta strategy you could do. Not all of you can do it, but your goal should be something like this. Then you do STR means short-term rental, MTR means medium-term rentals, and LTR stands for long-term rental, which is the most traditional way of doing things. So 1 to 4 unit is the best. Single-family residence, duplex, triplex, fourplex, 1 to 4 unit. Why is the best methodology, the best blueprint? Because you can still get the very favorable Fannie Mae 30-year fixed rate mortgage rate loans, conforming loans. Okay. And Richard Advani can tell you all about it because he's been an investment loan agent for decades. And he has, Richard, my co-host right now, has helped thousands of investors to get financing in all 56 to buy this type of houses. So open your doors to Airbnb, but the way you think over time, when you scale your portfolio consistently, here are the renters you want. These are the type of renters you want to occupy your doors. They are vacationers. Yes, they can buy a rental property and convert it into an Airbnb short-term rental. Yes. And you can do mid-term rental and you can rent for tenants longer than 30 days, less than 120 days. Mid-term rental is an up-and-coming asset class. Is really going to blow up the housing market for the foreseeable future. So pay attention. So you can mid-term rentals, you can rent to traveling nurses, healthcare pros, digital nomads, corporate renters, displaced homeowners, traveling professionals, remote workers, insurance agency, people. Anyway, the list goes on and on. And finally, the most traditional way of achieving wealth many years, something Richard and I do mostly, is long-term rental, annual renewable lease, LTR. Regular renters that need a place to rent. Okay. And in terms of location, you should buy in Midwest and South and Southeast because these markets are the most affordable and cash flow, all the numbers make sense. The whole 9 yards. So that is my summary of how to design, build, and scale your massive real estate portfolios for any potential turnkey beginner or experienced investors out there. Wherever you're located in the country, anywhere in the country, anywhere in the world, you can do this kind of strategies. Richard Advani, now let me hear your thoughts as to my philosophy of having an open door policy.
You got all the good titles today. So first, I like the example, right? You show with the $200,000 investment, obviously, how you can create and grow a very large portfolio. Now, what that $200,000 didn't take into account was what you were talking about also, the primary element. Traditionally, in order to buy a 4-unit property, even as an owner-occupied property, if you wanted to use a conventional loan, you had to put 25% down. And with the huge changes that happened recently, which, by the way, I watched a webinar, I know Seewing did one, you could put just 5% down to buy a fourplex or to buy anything from a 2 to 4plex. And keep in mind, in a lot of markets, a fourplex is $1 million, 1.2 plus $1,000. If you're buying a $1.2 million property, putting $60,000 down on it, and you got these other 3 units to rent while you live in the one, and then eventually you're all 4. Talk about house hacking. That is really the quickest way to establish a portfolio and build wealth. And if you throw that into the example, right? So instead of 200, let's say you invest 250, including buying a $4 million 4-unit for 50,000 down. Look at the total portfolio you would have amassed, right? With just a $250,000 investment. You're going to own at that point a couple $1 million in real estate plus, and you're going to be generating cash flow. It doesn't take tons and tons of money to get into investing in real estate, but also for a lot of people, it's like, okay, I don't have 200 grand, right? Where am I going to come up with 200 grand? And where am I going to come up with 50 grand? If you don't own anything yet, go to that part of town that's maybe 30 minutes away from where you live now, where you can buy a 4-unit for 400 grand, right? 5% has 20 grand. So I know a lot of you have 20 grand. Go participate in the real estate market. Buy this quad, live in one of the units for a year. Okay, you know what? It might not be as nice as the apartment you're renting now, but you own it and sacrifice for a year and then move back to your apartment a year later, or a year and a half later, 2 years later, whatever it may be, and rent the whole 4 unit out, right? Versus sitting on the sideline saying, oh, I can't afford it. And it takes financial humility as well to do something like that. Because I pitched that to friends and they're like, oh, they're paying $2,600 a month in an apartment, and I'm a 1-bedroom apartment. And yeah, it's a nice building and all that. I'm like, man, you go buy a quad for 20,000, 30,000 down within 20 minutes from you. And yeah, it's not the perfect area you want to live in, but you own it. Like everyone wants the riches and the success, but they're not willing to do the sacrifice. And most of them, I've had one or two dive deeper in it, but most of them are like, oh, I like where I live. I like to be comfortable. And it's like, okay, well, if you're not going to make the sacrifice, you're not going to build the wealth, right? So there's huge opportunities out there. If you don't own real estate, get on it, utilize this 5% down. And if you do have a primary home, even if you can scrounge together, the example was $200K. You don't need the $200K right away, right? It was a combination of 5 properties. You buy each property at $40,000. I know a lot of you can set a 6, 8, 12-month goal to save up 40 or 50 and make your first investment. It's really exciting to watch new investors get off the fence and stop their analysis paralysis, because the magic happens after that first property, right? When you unlock Pandora's box and you buy the property, and 2 months in, 3 months in, you've got your red, then you're excited, right? All the nerves are gone. You're like, okay, this is real life Monopoly. I want to find Park Place at some point and buy that and work your way around. And people move very quickly. They may take years, and they'll tell you their biggest mistake is taking those years, but they may take years to buy their first rental. And then within a year and a half after the first one, they've got like 6, right? Because you start redirecting everything that you can to be able to acquire more real estate. And it's exciting to watch that switch happen in people's head, because I remember when it happened for me. So yeah, if you're on the fence still, as we always say, get off it.
Yep, that's right. You pretty much recap everything I want to say. So my quick thought is, as we conclude this webinar, is not is your mindset, right? Is your motivation, your commitment, overcome fear, all of those attributes that you need to have. You got to do the work. It's not, you have to delay gratification. You just have to create a positive mindset. You have to want it really bad, and you can't be lazy. You can't be paralyzed with all the negative headlines out there. And a lot of people are happy, believe it or not. And so it is very sad. And yep, it's very much doable. It's up to each of you individually to commit to it, to dedicate yourself, to do the work, and don't be lazy, and do whatever it takes. And the future will be very bright for you financially. Yeah, this is a really quick recap, and that's the blueprint we just created for you. It's going to take time. You have to delay gratification, but the journey is very worth it. And we're here to help, Richard and I, to help you guys to achieve your definition of American financial dream. Thank you so much, Richard, for your time. This is Seewing Yee. Thanks for watching. I'll see you next time. Have a nice day. Bye-bye.